90% of monthly dividend stocks are pure garbage. Welcome back, everyone. There's really two main ways to receive monthly dividend income. You can buy and hold monthly dividend stocks, or there's another way that will make you more money, have more consistency, and will be way less volatile over time. So here's the truth about monthly dividends, and it's not my truth. This is just factual data, which I'm going to show you in this video. Also, stick around to the end, and I'm going to show you where to find a bulletproof download, a bulletproof dividend strategy download for monthly income that is rock solid. So let's talk about the truth about monthly dividend stocks. Now, in the beginning of the video, I said 90% of monthly dividend stocks are garbage. And that's really true. There's really 4, 5, maybe even 6 monthly dividend stocks that are a complete exception to this and that I actually own and I love. Let's get those on the table right now. One of them is Realty Income. Love that stock. Great stock. I own it. Another one is LTC, Long-Term Care. Another one is SJR, LAND. There's Stag Industrial, maybe one or two others, but the rest of them are essentially garbage. And let's go over exactly what I mean by that. So most monthly dividend stocks are BDCs or MREITs. Now let's break down exactly what I mean here. BDCs are business development companies. Business development companies typically, they get loans from major institutions or banks at a certain interest rate, and then they take that debt, they turn around and they loan it to small and medium-sized startup companies at a much higher rate of interest. So their entire business model is built on debt. Now, both BDCs and MREITs are more interest rate sensitive. So when they borrow the money, depending on what interest rate environment we're in, it could be more expensive or it could be less expensive. MREITs are simply just baskets of mortgages, right? A lot of time there's leverage used within those as well. So these typically are higher risk, which equals higher volatility because of that leverage. And so they know that they have to pay investors monthly just to kind of entice them to become shareholders of their companies. And again, this is the second point that we come to. They have to essentially dangle that carrot to bait investors into owning this because they know that interest rate sensitivity is so prevalent in these types of investments that they know that smart investors don't want to wait a calendar quarter at a time to get paid. They want to siphon as much money as they can out of these companies. These companies know that, so they have to pay monthly, right? So get paid every month, and investors, again, sometimes get baited into that. It's also administratively expensive for companies to do this. Even Realty Income, they've built their premise on the monthly dividend company, and that's great. And they understand the expense of that, and they even mention that. They say, although it's administratively more expensive to do so, we enjoy rewarding our shareholders every month. They've built their entire premise on that. I get that. Again, those exceptions that I mentioned, we're not talking about those stocks here. So again, 12 pay periods instead of 4. Another reason why 90% are garbage is because compound frequency is heavily overrated. Where's the meat? So if we were to take $1,000 and we compounded that monthly at 5% and $1,000 with 5% compounded quarterly, again, both 5% annual rate of returns, one is compounded monthly, one is compounded quarterly. As you can see here over 10 years, the difference is very minute. So the whole fact, now again, is there a difference? Sure. To be fair, if we're going by the data, yeah, there is a difference. But it does not outweigh all of the other terrible things about most monthly dividend stocks. So again, the compounding frequency really isn't that big of a game changer. And although it's nice, again, it doesn't outweigh the negative things. When you expose your money to all of these things together, typically, also potentially, even in the future, you expose yourself to lower long-term total returns because you're simply owning lower quality investments that use more leverage. Also, here we are in 2019 going on to 2020, a lot of these BDCs and MREITs have performed terrible over the last decade when we've been in one of the longest bull runs in our history. So you have to ask yourself as an investor, if these investments perform terribly in good economic cycles, in fact, one of the best we've had in history, How do you think they're going to perform through flat markets or recessions, right? Or correctionary periods? Ask yourself that. So instead of doing all of that, in fact, let me show you some examples of some of these monthly dividend stocks that are complete garbage. Let's hop on the computer and I'll show you exactly what I mean. All right, so here's a factual, data-backed example of why most monthly dividend companies are complete garbage. We'll go through some examples here. Here is ticker HRZN, Horizon Technology Finance Corporation. First of all, it's a microcap, so any sort of dividend income from microcaps are usually kind of sketchy just by the fact that it's a tiny company, right? Why is it such a high yield? Again, this baits newer investors in because they love that massive percentage that they see. So let's take a look. Let's see what the company even does. I'm down here. Oh, look at that. Business development company already, right? So we go to summary. One day, oh, it's green. Let's take a look at the max or even the 5-year. Okay, so terrible performance there. Again, over an excellent economic period. Take a look at the max. So terrible principal erosion, right? So you're losing money there. So let's take a look though. Have they been increasing their dividend? Okay, so HRZN, let's take that and let's go to the dividend channel. Although dividend channel doesn't get all the dividend data right 100% of the time, they are usually fairly accurate. Okay, so monthly dividends, as you can see, 10 cents, 10 cents, goes all the way down, all the way down. Oh, look at this. So in November 2016, they actually cut their dividend from 11.5 cents down to 10 cents. Okay, so they had a dividend cut there. And since 13, they were paying the same. And it looks like they had a dividend cut there, although you kind of want to make sure that there's no stock splits that would cause that type of data to be shown there. So then let's go over to split history. Okay, so 0 stock split. So what does that mean? That means that right here in, where are we at here? In November 2012, in fact, they even skipped December, it looks like. Do they do that every year? No, they don't. So not only did they cut the dividend, but then they skipped a month as well. So that's a terrible monthly dividend stock right there. Again, you're not going to be making much money there. Let's take a look at another one, CPTA. So let's take a look at CPTA. I'm assuming it's a, okay, here, again, another microcap, which is terrible. Negative earnings per share, terrible. And massive dividend yield, terrible. Let's take a look at its profile. Let me guess, business development company. Oh, look at that, business development company, another garbage monthly dividend stock. So let's take a look at this. Let's take a look at the 5-year chart, terrible, right? So here we are, it was 18, almost 1830 a share. Now look at it. So if someone would have invested just several years ago, look how much money they've already lost. Although again, all newer investors typically look at, oh man, look at that big fat yield, and they pay monthly. So let's take CPTA and let's go over to dividend history and get quote, okay. Okay, 19, 8, 8, 8, 8, 8, boom, boom, boom. Look at that, massive dividend cut, almost in half. They went from 13 cents to, excuse me, 1.3, yeah, 13 cents to 8 cents, 8.3. Okay, oh, look at that, another dividend cut. Look at that, look at these massive dividend cuts. 15, and then dividend cut here. I'm hoping these are splits, okay? So let's take a look. CPTA, let's go to split history, okay? CPTA, 0 splits. So when you see these breaks here, those are actual dividend cuts. But the reason, again, the reason the percentage looks so high is because the share price keeps dropping. So of course, that pushes the annual yield up, the annual dollar amount, or excuse me, yeah, the dollar amount there, that pushes that up in as a percentage because the share price keeps freaking dropping. So of course, that's going to look very deceiving. Again, most of these companies are garbage. Let's look at AG&C. I was looking at this earlier. This is a garbage one, but it's more popular simply because look at this market cap. It's a little bit bigger, right? It's a mid-cap size company. Look at this, negative EPS. Look at this yield, garbage yield. Let's take a look at the profile. I think they're based in the US. They should be here. Yeah, United States. And it's a REIT, okay. Residential mortgage. Oh, look at that, MREIT. So let's check this out. Let's go here. And 16, oh, look at that. They just had a dividend cut right there. 18. Oh, another cut in 2016, okay? 22, look at that. Look at all these cuts. So again, let's make sure, let's be fair, let's make sure there was no stock splits or anything. A, G, and C. 0 stock splits. So again, this is just another garbage ass monthly dividend stock that baits investors into thinking that they're doing themselves a solid by buying these monthly dividend pairs. These are all garbage. So let's get back and I'll show you a much better way, much more profitable, much more solid, much more disciplined approach to receive monthly income. Now there is a way to receive monthly income from excellent dividend stocks and also get a pay raise every year consecutively with lower volatility. And that is through what's called building a dividend ladder. Now, if you click the link in the description below, I have created an entire list of excellent stocks and which months that they pay, so you're able to build your own dividend ladder to where you're able to receive consistent dividend income. Here's what I mean. There's excellent companies. Now, all 3 of these companies are dividend aristocrats, meaning they've increased their dividends consecutively every year for 25 years and ongoing. We have Ecolab. Ecolab pays in January, April, July, and October. Then we have Lowe's that pays in February, May, August, and November. And then we have McDonald's that pays in March, June, September, and December. So as you can see, January, February, March, April, May, you own these 3 stocks and you already have monthly income. Okay, so once you own these 3, you go layer another 3 and another 3. And then you have a diversified portfolio where you own companies in different parts of the economy that sell different products and services, although they pay their dividends on different months. So if you stagger or ladder your dividends with quality companies, you can avoid all of this BS up here, all of that stupid monthly dividend BS, by simply owning quality companies that pay on different months within the quarter. Again, if you click the link below, you'll see the list. You don't have to do any of the work. I've created a list exactly for you, completely free. If you enjoy the free download and all the resources I showed you in this video, don't forget to give me a big fat thumbs up and give me some feedback in the comment section down below. So with that being said, thank you so much for watching, and we'll see you guys next video.